All right, welcome everyone to tonight's Sunday macro wrap up for Sunday, November 2nd, the first Sunday of November. Pretty crazy how we're already in the last 2 months of the year of 2025. Pretty much close to the end of the year here. Before you know it's going to be Christmas time as well as New Year's. So pretty exciting stuff heading into the end of the year, though. We're on day 33 of the government shutdown. By the 5th of this week, if it continues, it'll be tied for the longest government shutdown in U.S. history, and then or further than that, it'll break the record essentially. So we'll see what happens there. There's a lot of key data points that have not been released over the past month, namely with the labor market as well as inflation. This week is the first week of the month, which is normally Labor Data Week. And so with it continuing to be a closed government, we could continue to see that data be delayed even further. And so we still have to rely on private data, which still continues to come out. And so it'll just be limited from that. Really, there's only two main things that we'll be looking at this week, or actually four, which we'll get into in a little bit. But the ADP jobs numbers continue to come out, so we'll be looking at that as well as some of the ISM manufacturing and services indices. But before we get into all of that, as well as some of the charts, for those who are joining here for the first time on our live stream for the Sunday Macro Wrap-Up, the way that these work is that the first 30 minutes of the hour is streamed, and the last 30 minutes is offline just for our Macro Optics members. And so if you'd like to hear more of the discussion offline where we look at the actionable ideas and some of the more tickers that are providing opportunities, then you can check out our website at macro-optics.com or send me a DM on our socials there. But let's go ahead and get right into it here. So obviously this past week, the big takeaway was that the Fed lowered interest rates by 25 basis points. This is the second time that they've cut this year, and there is a very high anticipation that they're going to cut again by 25 basis points in December. But the key thing that Jerome Powell was being cautious on was that it's not a guarantee. It's not a guarantee that they're going to cut 25 basis points in December, or even further from that point. And so the futures market definitely had a little bit of a shock from Powell's comments, and there was a little bit of a dip in the markets because of it. And what was interesting was if you take a look at the futures markets, they went from pricing in 4 cuts in 2026 to only 2. And so that's a pretty drastic change. He was mainly hinting that inflation is still remaining way above target. Around 3% for headline. And so because of that, they're going to be a little bit slower to cutting interest rates. Now, my team and I do think that they will continue because you're still getting a large deceleration in the labor market. That's continuing and doesn't look like it's slowing down at all. And then also, two, we could continue to see inflation come down heading into 2026. So the rate cutting regime that Powell is on may not be totally halted, but it will be slowed down a little bit. But another key takeaway from this meeting was that starting on December 1st, they're going to conclude the reduction of their aggregate securities holdings. So they're no longer doing what's called quantitative tightening, where they were allowing Treasury securities to mature and roll off their balance sheet. They are now taking those rollovers and reinvesting them into shorter duration bills, right? And so they're essentially just changing the duration on their balance sheet. And a lot of people took to Twitter and other online spaces and concluded that this meant that they were going to do all-out quantitative easing, which is not true. This is mainly just halting all reductions in their balance sheet. And so this is really the first step before they do quantitative easing. So I wouldn't be surprised if they do end up expanding their balance sheet instead of keeping it neutral like they are right now, maybe later in 2026. But as of right now, they are no longer reducing their balance sheet. Now, on one side, you could say that's good news. On the other side, you could say, hey, there's probably a reason why they're doing that. And on Twitter, it was pretty interesting. A lot of people were highlighting this huge acceleration in bank reserves on the month end there. And there's a huge spike in this metric here. And so usually during month end or even quarter end, there's a large fluctuation in bank reserves and holdings, only because there's what's called window dressing, that banks kind of shore up cash around the month end or quarter end for accounting purposes. And so I don't think that this was a huge cause of concern, even though I saw a lot of people go online talking about how this is a sign that we're going to have another banking crisis, blah blah blah. I don't think that this is a huge warning sign, but it is interesting how they haven't used this in quite some time. I think the last time was during the 2023 regional banking crisis, but I really don't think that this is a huge sign that there's going to be a lot of funding stress, because you still have very narrow credit spreads and volatility is still incredibly low. So I don't think that this is a huge sign for to ring the alarm bell. Now, if this type of thing continues more frequently, then that might be more of an indicator. But I think this one-off, we still have to wait for more data at this point. So I saw a lot of people freaking out about that. I don't think it's something that is to worry right now, but we do have to keep an eye on that. Taking a look at some other macro data last week, we still continue to get more data showing that growth isn't necessarily accelerating in the same way that we would like to, in order to call this more of a soft landing, right, where inflation comes down and growth remains steady or actually accelerates. We still saw that some of these leading indicators were showing a slowdown. And so, specifically the Dallas Manufacturing Index still remains in contraction, a little bit of a slight acceleration, but not much. When taking a look at the Dallas Fed Services Index, that did have a further deceleration in October. And so that's not necessarily the direction you would want that to be seeing. Now, of course, these are, focused regions in the United States. It doesn't mean that the entire United States is experiencing this type of thing. But, typically you want to make sure that all of the different regions are having some type of acceleration together. That's typically a good sign, but we're continuing to get that mixed signal there in terms of leading growth data. So not too much of good news there. Same thing when taking a look at the Richmond Fed Manufacturing Index, that continued to soften, as well as when taking a look at home price growth, that also led to another decline there. As you can see, this is the Federal Housing Finance Agency Home Price Index, the year-over-year change, and currently it's at 2.3%. That was for August. It's typically a 2-month lag for this housing data. But just to give you a little bit of perspective, if we take a look back and max this chart out, you can see that, this is the lowest point that it's been since around May of 2012. So that's pretty significant. We'll see if this continues lower. The lowest that it's ever gotten was during the 2008 Great Financial Crisis, which was around 9.6%. I don't think we're heading down that way anytime soon. But it is interesting how the year-over-year rate of change for the home price index has, decelerated pretty substantially. We'll see if it gets into the negatives. But what was interesting was that ADP, which is the private jobs survey, they came out saying that for the month of September there was 32,000 private jobs that were lost. Right. Now, this isn't the official number from the government. The ADP is a private surveyor, but this number is still pretty important. And what's interesting is because of this government shutdown, they are now going to, they just announced this past week, they are now going to do a weekly report showing the 4-week average of, for that week on what's going on with the jobs market. And so you can see here that they added 14,000 jobs during that week. This was the first report And so, yeah, every single week they're going to come out with this data. This is a brand new metric. And so if you take a look at this on tradingeconomics.com, you can see that it's just one big bar so far. Well, that's because it was the first reported number on October 11th. So that's one thing that we can now add to our list of jobs market indicators. Now, this isn't the end all be all. This is just another, private metric that we need to make sure that we're tracking the rate of change of. It's nothing set in stone, and the monthly data will always take precedent, but this will always be a nice little leading indicator since we don't have, the initial jobless claims anymore with this government shutdown. And then taking a look on more the tariff front, China and President Trump, or the Chinese leader Xi Jinping, came together, and Trump called it an amazing meeting, very nice. Both sides agreed. There was many great points, but apparently they came to a conclusion where Trump mentioned a 10% reduction in the China tariff that they currently have on, and then also China after the meeting said that they were going to roll back their rare earth controls, which was one of the things that was huge a couple weeks ago. So on the tariff front, we're seeing improvements as well. So that's, somewhat of good news. Now, what was interesting was I saw this tweet as well because, the cryptocurrency community is freaking out a little bit because they're saying, hey, we got Fed rate cuts. United States and China just made a tariff deal. The Fed said that they're no longer going to do their quantitative tightening, and they're going to stop reducing assets on their balance sheet. What gives? Why is the crypto market, experiencing all this redness? Why is it bearish? As we know, the cryptocurrency market is very sensitive to central bank liquidity. And if we take a look at, what central bank liquidity has been doing, going back to what we spoke about before, which is, the reason why the Fed is starting to end their quantitative tightening measures. Well, it's because of net central bank liquidity right here. This is one of the most important charts, I think, now going into 2026. And what this does is it calculates the difference between bank reserves and subtracts the number in the reverse repo facility, which again is kind of like an enormous cash parking lot that's held at the Fed. That's really been funding the liquidity markets over the past 3 years. And it also subtracts the Treasury General account, which is the government's checking account that's held at the Federal Reserve. And ultimately, when this number goes up, it's pretty positive for liquidity sensitive assets like Bitcoin and other cryptocurrencies, as well as small cap stocks, things like that. And when this starts to go down or is bearish, that's typically not a good sign. And so, when taking a look at this, zooming out here, you can see that this chart, when we compare it with a chart of Bitcoin, right? If we compare these side by side here, let me just go ahead and do that. So net central bank liquidity is in orange, and Bitcoin is in blue back there. You can pretty much see, net central bank liquidity bottomed in September of 2022 and then started to steadily rise from there. And then Bitcoin pretty much followed suit. And they were, in short-term aspects, there were times when they were oppositely correlated, but, zooming out on the long term, they're pretty positively correlated, meaning they follow each other. And so what's interesting is that ever since net central bank liquidity, if we zoom into kind of what's going on right now, let me just adjust this chart here. If we zoom in, we can see that ever since net central bank liquidity started to really drop off here, Bitcoin's been struggling. And, this isn't to say that Bitcoin is about to have a huge drop, but, with this metric continuing to fall from here, and now we're entering into a period for the first time really since the pandemic of a, tight liquidity environment, this could put some more headwinds on Bitcoin until we get into an environment where the Fed announces that they are going to start expanding their balance sheet. Right. And so this could take a little while. But yeah, so pretty much, when this number is steadily going up, this orange line, usually that's when Bitcoin thrives. It doesn't mean that Bitcoin can't perform in this environment, but typically it's a huge headwind, which has been proven to be the case, really since Bitcoin has been struggling since July. You know, so that's sort of the main reason that I think that liquidity sensitive assets are going to continue to struggle here. But just taking a look at the performance over the past week here, taking a look at the top assets that my team and I like to follow. This is the 5-day performance for some of these different things. The dollar was among the better performers last week. As we know, the dollar is in bullish trend. It's at levels pretty close to where it was at back in July of this year. So if we take a look at the DXY and zoom out, we can see that the dollar is near the highest levels since July, the end of July of this year. But this is a much stronger trend than what we saw during this volatile spike in the dollar, right? And so yeah, the dollar being bullish trend obviously does not help a lot of foreign equity markets, foreign currency markets, and it could also be a headwind for some of the liquidity-driven assets that we just talked about. So the dollar and Bitcoin currently are not in a positive correlation. So that's also a headwind. Let's see. Yeah, so the S&P 500 was basically flat. Gold had a little bit of a dip there. Oil as well. Inflation, the 5-year break-even inflation rate also had a dip. And then Bitcoin had a continued negative balance for last week as well. Taking a look at the different sectors of the S&P 500, every single sector last week was in the red except for tech. And that made sense because we had a lot of tech earnings last week. Specifically, I believe it was Apple, Microsoft, Google, Amazon, and Meta, all of which had pretty decent positive surprises except for Meta. Meta was one of the only ones that we had in bearish trend. And as we can see here, Meta had a pretty terrible week, negative 13%, almost negative 14% on the week. So yeah, not all Mag 7 stocks are created equal, but as you can see, Amazon, Nvidia, and Google all were the best performers last week, over 6%. Tesla, nice little pop as well. Broadcom and Apple all were having accelerations. Microsoft ended up with negative 2.44% on the week. So that's what we saw really for the tech earnings. But yeah, I mean, it's pretty interesting how last week it was a pretty large negative week for most, except for the big tech. And as we get into these more liquidity, I guess you could say, not very ample in liquidity levels, you could see a more concentrated investment into some of these larger tech stocks. So this is similar to what we saw around the beginning of 2023. And so with the percentage of stocks in the S&P 500 that are above their 200-day moving average below 50% or around 50%, this is just showing that there's more of a concentration now heading into these larger tech stocks. Earnings this week coming up, though, aren't as crazy. I think, yeah, the only thing that we have is Berkshire, Palantir, and AMD, McDonald's, Shopify as well. So those are the ones coming up this week. All right. In terms of the yield curve, so my team and I like to pay attention to what the yield curve is doing and its performance, because the yield curve is basically the bond market trying to price in the economy, what's going to happen from here. And pretty much since mid-April of this year, it's been in a flattening, specifically a bull flattening, which there's 4 different types. But bull flattening is typically a signal that the bond market is showing when it expects growth to start to slow down, as well as inflation and the Fed about to cut rates because of a more weakening economy. And so typically what happens after a bull flattening is some type of steepening. And historically, it's a what's called a bull steepening, which is when the Fed starts to cut rates quickly because of something breaking in the markets or because of some type of credit stress. It doesn't happen every single time like that, but the last time that we had a very aggressive bull steepening was when we were heading into the large sell-off that happened earlier this year, right? So that's kind of what I'm looking for here, is a large steepening, and we'll probably know when that happens because we'll just see a large drop in the 2-year government bond yield. But yeah, as of right now, it's continuing its flattening. So yeah, we're just going to see continuation of slower or stagnant growth and inflation that could be just hovering around where it's at or falling. We're at an inflection point right now with liquidity, and it's not necessarily a cause for concern right now. We could see some more volatility heading into or at some point in 2026. But yeah, this isn't a time to panic and panic sell and go into cash, but it is a time to be very strategic on making sure that you're identifying bullish trends and owning those bullish trends. Easier said than done, but that's what my team and I do best for our members in our community. And yeah, so I mean, in this environment, typically bonds do well, other rate sensitive assets, but long duration is definitely going to be a continued long for our team. And so these are assets like, or these are longer duration bonds like TLT or IEF. These things right here, they'll probably continue to do well in this type of slowing growth, slowing inflation environment. So yeah, that's what I'm seeing. Credit spreads still remaining pretty tight, which is not signaling any type of credit stress in the markets right now. So all the people who are panicking, we're just not seeing the credit stress right now. And yeah, volatility remains low. Still a great time to take profits if you're up a lot on some things. My team and I are signaling to raise some cash into this environment. And that's not saying go on the cash, because I just said you have to be strategic on which assets you want to be exposed to. But what I'm saying is that if you're up a lot on some things, just trim a little bit off the top. Get ready. If we do have a little sharper short-term dip, take advantage and buy the dips in bullish trends. So yeah, that's pretty much all I'm seeing here. What we'll do is we'll go ahead and end the stream there. But for those who are on the Zoom call, hang tight. We're going to get into some assets that I like, as well as go over some of the different ETFs and stocks that are on the list here. For those that are on the stream, we appreciate you guys for joining. If you guys want some more information about our communities, again, just go to our website, macro-optics.com. We still have the 6-week challenge going on from now until the end of the year. So if you guys want more information on, implementing a macro process, as well as seeing which assets my team and I like, you can go ahead and take a look at the link in the description below in the YouTube channel, as well as the link that's in our social media bios. But we're going to go ahead and turn off the stream and head into the Zoom call only. So let's say bye to YouTube, Instagram, X, as well as TikTok.